Give it right to you.
Yeah, Mike, what if I'm really wrong? I'll cover that too. This is why I want you to write it down, because this isn't what you're used to thinking. So it's new thinking for you, and you're lost. But as an investor, this makes perfect sense. So let's say it doesn't go to 41.10, because that's our break-even 41.10, correct? On expiration day, the stock's at $41. On expiration day, the stock is at $41. Well, now you're only down how much? 10 cents, because your break-even is 41.10, correct? So on expiration day, you're going to have to buy to close the 42 puts. Is that correct? For a buck, you're in it for 90-cent credit. You're down 10 cents. See, the stock stopped at 40, had pretty good support there. It's in an overall uptrend. I think I'm just going to buy back those September 42 puts, and I'm going to sell the October 42, 41 puts. Still the same trade. I'm just rolling out now. I'm rolling out to the October month versus September. If I sell the 42 puts, I'm going to bring in how much money? Stock's at 41. You'll bring at least $1 of intrinsic, maybe 50 cents a time. Now you buy the 41 puts for how much? 75 cents, I don't know. So you got a 75-cent credit. Okay, 75-cent credit. Now you want the stock to go to 41.25 by expiration date. Goes above 41.25, you start making a profit above 42, and now you make 75% on your money. But it took you 2 months to make 75%. Well, you were only after 40% once, you make 75% two. Is that okay? Remember, your overall trend was an uptrend. You just had you just got caught in the cycle, because all stocks go up and they go down. And they go up. You just got caught in the down part of that cycle. But you just keep selling time each month, and eventually you'll get stuck back where? On the up part of that cycle. Wow. This couldn't be that easy. It is. Once we think of it, we just need to think of, hey, the stocks go up and they go down. And if I just keep staying in that trade until I get to the up part of the cycle, I can close up my trade for profit. Now, Mike, what if I get in that one trade that only has the down part of the cycle? Right. For 18 years. Right? What if I get in the down part of that? Oh, anybody brown overload right now? It makes perfect sense when you think this way. And all we're doing is changing our thinking from, instead of just doing the trade for a 1-month trade, I'm going to do the trade until it's closed. It's not a 1-month trade. Each part of it might only be a few weeks, but I'm just going to keep doing my trade until it's closed. Now I'm going to close it when I have a profit. Now that might mean it's a 4-month trade. It might mean it's a 4-day trade. But I'm going to close it on my terms, not the stock market's terms. Because if you close on the stock market terms with a loss, not only is your account drop in value, you've also what? Accepted the fact that you're a loser. And if you lose often enough, you believe the fact that you're a loser. But if you don't take a loss, you don't think you're a loser, which is why I said to you first thing this morning, I honestly believe that no matter what stock you give me, I will show you a trade that I believe I'll make money on. That changes a little bit. Okay, so what happens if it goes way down? And it goes through 41 and keeps on dropping, keeps on dropping, keeps on dropping. Well, you still own the $41 put, right? If you still owned it, if you closed it for profit, you're already profitable because it kept dropping until you finally got out of a profit. And we said put you good till cancel there. All right, let's say that maybe a cover call could be perfect for a downtrending stock. That's a nice one. Okay. Questions on this so far? I'm sure you're lost, but that's what I want you to write down because it makes sense when you do it on paper because we all have a different way of doing things. My brother's an engineer, and everything has to be mechanical for him, exact for him. And it's hard for me to teach him what I want to teach him because the stock market's not exact. And when he tries to show me something, it's so exact because I'm not an engineer, I don't even want to pay attention to it. It's way over my head. We all have a different way of viewing things. That's why I want you to see it on paper because the more you see it on paper, it'll start to make some sense. The first time I saw anybody ever do a spread trade, I was already in the stock market for about a year as far as I know what a spread trade was. I was from trading calls and puts. And they showed me a spread. I said, what's the spread? They showed me. I said, wow, that's interesting. Show me another one, which was my way of not saying out loud, I haven't the faintest idea what you just did. Right? So after they showed me about 20 of them, it started to make a little bit of sense because we all view things differently. All right, what kind of questions you have what we covered here so far? Does everybody see what we're doing here? We just went to a put spread, but because it has $1 strike prices, look at how we were able to change the trade versus that $5 strike price. So it makes a big difference which strike price we choose. If I had to stick with a $40 and a $35 strike price, it might not have ever went down far enough to 35 where I ever made a profit if I was wrong. It makes it really difficult. And then if I had to roll back up, I'd have to go from the 40 to the 45. It might not have made it back to 45 for you to ever close out the trade. So it has to have the right strike price.
There's an online question about, it's quite long, so I'm not sure how to
That's
word
okay.
it, but something about an example on, well, you mentioned before that the Greeks are manipulated and you can't really trust them. Yes. All of toss trading or trading, which we've all been through, says that, yeah, you got to rely on the Greeks. I mean, can you give an example of
Sure.
what you meant?
The question is, a lot of the training you go through right now is around the Greeks. Remember, who is toss? I'm not saying anything bad because I like toss, but who is toss? Toss is what? Brokerage firm that was started by market makers, floor traders. So what do you think they like to do? Greeks, because they created them for them to make money. So would you like something you could create and make money off of? Absolutely. Yeah, and I didn't say I don't like them completely. I like them to see if a stock or if an option is overvalued or undervalued when I get into a trade. Once you're into the trade, and it says this will decay by this much and it'll do this over here, I can show you time after time after time it doesn't work. We can look at the trade that we just did here on our last perfecting profits, which is ADM, Archer Daniels Midland. We bought a straight put on it. This stock was down yesterday, and the option didn't drop yesterday, even though the time value said it was supposed to drop. Why didn't it do it? The Greek said it was supposed to drop, but it didn't. Why not? Too much volume, too much open interest. Wasn't in the market maker's best interest.
Oh, is that what happens?
That's exactly what happened. Remember, the options Greeks were created by the market makers for the market makers. So if you're trying to use them, find out what something will be in the future, you're using what they made for themselves to make money. So you automatically put yourself at a disadvantage right off the bat.
So should we be keeping an eye on the open interest?
What you should keep an eye on, open interest is a good one,
Right.
big difference, but what keep an eye on for you is the intrinsic value. The market makers can't mess with the intrinsic value. So if you take time value completely out of the price of the option and say intrinsically, here's what the option has to be worth, and that's all you trade off of, they can't manipulate it and take any cash from you. As an example, stock is at $26 per share, and you buy the $25 call option. What's it worth intrinsically? $1. Market makers can't make it any less than $1. Because if they do, I'm buying that option. I'm going to exercise it right away and make immediate profit right off the bat. I'll buy 800,000 contracts if I can afford it, and I will exercise each one immediately to take the profit. Because if I could buy that option for 50 cents, which means that I have the right to buy an option for 50 cents, which gives me the right to buy a stock at 25. As soon as I buy it at 25, I'm going to exercise my option to buy a stock at 25 and immediately sell that option or that stock on the open market for 26. I'm going to make 100% of my money on every one of those. The market makers cannot change the intrinsic value. They just can't do it because it's an immediate loss to them. What they can change is time value. So I go out and I buy an option, and I buy the $25 call stocks at $26, and I pay $2. Yes, I pay $2. Now, I look at my Greeks, and the Greeks say that this stock goes up. For every dollar this stock goes up, for every dollar stock goes up, I've got a delta of 0.7, which means for every dollar stock goes up, the option will go up how much? 70 cents. With a time decay of 5 cents a day. Right? So I'm looking at the time decay. So in other words, if I buy this option today, $25 call for $2, and this stock goes up $1 tomorrow, I should have a 0.7 delta with a 5 cent rate of time decay.
Right.
How much will the option go up? 65 cents. It will go up 70 cents for each dollar of the delta, but it has a 5 cent per day time decay. So it goes up 70 cents, drops by a nickel. Go up 65 cents. Next day that stock goes up to $27, which is up $1. Went from 26 to 27. What should the option be worth now? $265. Right? That's what it should be worth. So if I look at it, I should be able to sell it for $265. I look at the option. Option's worth exactly $2. They can't do that. They can do that. Remember, they set the option prices of the Greeks based off the implied volatility. Well, who sets the price of the options? They do.